Most traders struggle to spot valid breakout structures and market structure shift, and that's why they keep losing. In this video, I'll show you the market structure trap everyone falls for and go over 2 proven methods to identify only valid A+ breakout structure and market structure shift. This is part of the high probability trading series. Make sure to watch all the episodes to build your A+ trades. Let's start. Confluence 3, valid breakout structure and market structure shift. Now, a lot of people look at this specific pattern and they think that, when price takes the high, takes the low, breaks below it, this is a signature that banks leaves. And then this is where banks are involved and changing the direction of the market. And this is all illogical. This is something that does not make sense, because when you think about banks, when you think about, this is a pattern in price action that sometimes can signal reversal, but it's too misunderstood and it's too simplified, and it's looked at in many different contexts, that instead of signaling reversals, it actually keeps you losing. So it might sound funny, maybe shocking for you, but this specific thing, if you think about what's going to happen next, probably price going up and breaking the high instead of continuing lower. Why? We're going to be explaining all of this, and instead of calling this a market structure shift pattern, I'm going to call it a market structure shift trap, because it's a trap. It's like telling you that we are about to reverse when in reality it's a continuation. So the market structure shift trap, why does it fail? The reason is, the first one is that it's a pattern only. The problem is a lot of people look at this as a pattern. Oh, when I have this, go short immediately, when in reality it's going to continue up. And whenever price is going lower, whenever we break above the last high, that is a signature, and that is where smart money being involved. That does not make sense. It's only a pattern that you are looking at without context. And whenever you look at something with no context, anything, an imbalance, okay, liquidity sweep, no context mean that it's most likely gonna fail. And then why also it fails? Because you're taking it against a trend. So price has been moving up for a long time, and you think because of this it's gonna change the whole thing here. That does not make sense. So when taken against a trend, it's most likely gonna fail. And then no higher time frame alignment. So price has been moving up, and then you see this. If you don't align it with something here, probably it's not gonna work. And then if you look at this on the 15-minute and you see this happening, and then you saw this, and this is the only thing you're looking at, this specific pattern is gonna fail. Why? Because there's no alignment with the higher time frame. That means you're not relying on a higher time frame level in order to validate the pattern. When you don't do that, it's not gonna work, and it's mostly gonna keep you losing instead. And then one of the issues also is just focusing on the last low or high. Now, the thing is not the high or low, it's about the last. So a lot of people are going to be ignoring everything, and whenever we create a high, they're going to say this is the last high, you now look for longs. And they forget about everything that happened on the trend, on the price action range, on the that high probability range. Probably they're going to focus on only the last one and forget about everything that is significant. These are 4 points. The main one is that the pattern itself is not a true reversal. When it's just marketed as it's where the reversal happened, when in reality it's not. It's a pattern that a lot of time it's more of a continuation pattern, and that's what is going to be shocking for you. If you look at this and you look for longs here, it's better than looking for shorts. Imagine that. Go to the chart, try to backtest it, and you'll notice that it's even better when you think that the market structure shift is happening. You better look for longs instead of shorts, and you're going to see that most of the time it's going to work more, because it does not represent a true reversal, and we're going to see that on the chart. Now, I'm not just going over this and showing you the bad side of it. No, I'm going to show you the real side of it too, that sometimes it works, but how can we make it work? What are the things that needs to be applied, needs to be found to only focus on the high probability ones and avoid the trap, because that's the main goal of the video, and we're going to be doing that together. Before we continue, I've taken everything I've learned over the past 7 years and put it into one place. It's cool. Inside, you will get the full blueprint to finally make it in trading, including the exact strategy I use every day, the edge model. These are some of the trades I've taken with my members. You are welcome to join if you are ready to make the real change in your trading. Let's continue. Now, as I said before, 7 years of experience taught me this. You're gonna find the market shift pattern, and it's going to appear to you anywhere on the chart. And a lot of traders, including maybe you, including me previously, we're going to think that this is a reversal now. This is where banks are being involved and there's smart money. In reality, it's a trap, and prices are going to continue in the same direction. Take a look at this. Prices going lower, lower, lower. And then breaking this, what's going to happen is continuation. Now, the most important rule to apply in order to avoid the market shift trap is to always look for it at higher time frame key levels and never in the middle of nowhere. How is that? Because that's going to give you another confluence. That's going to give you another level that could push price. For example, in a bullish scenario, it's going to push the price higher. So it's another confluence. It's something that gonna make everything from going like 50% win rate to maybe 70 just by applying this rule. And if you ask me about one of the most important rules when it comes to trading, it's the higher time frame alignment, the higher time frame key levels. Anything on the higher time frame relative to the lower time frame, that is what time frame alignment is, and that is probably the most important rule when it comes to being profitable in trading. Now take a look at this. Price goes up, break structure, break a structure, and then where's the last low here? This is your last low. Oh, we go lower and we displace below that low. What happened? Continuation to the upside. Some people get trapped here, some people get trapped here. Continuation to the upside. And then we don't break the last low. We go up. We don't break the last low. We break structure. And what happened after? People are getting trapped here, people are entering here, and then price continue to the upside. Where does the market shift most of the time happen? When does it become valid most of the time? Here, when we reach a key level, that is bearish. So this is a higher time frame bearish point of interest. Price started to go lower, and then we have the market shift, but we also have a lot of other things here, which we're going to be discussing later. And then break a structure. Retracement, that's when you enter and follow the trend. So that's the real market shift. All these are actually continuation. Now I want you to look at this. Price has been going up. We create a low. We go up. We take that low. Sometimes we displace below. All right. In this case, not really. We did not. But you see, here we displace below the low. That is a continuation. Now, if you consider this one here, even if you consider we were going bearish here, and then we take the low, we go above the high. That is a bullish one. In reality, it goes lower. And then the whole thing here, when price is going up, the last low is here, we displace below. A lot of people thinking that it's now time to short. What happened is keep going higher. Now we create this low. Here there is one low here, and we break below it. This one I would say it's less significant, but then price goes up. This is a low where we close below it, price continue higher. This is a low now that caused this breaker structure. What happened? Goes below it, started going higher. Also this low here, this internal one, goes below it and then continue higher. And where do we have it too? So here, kind of, but here we break structure, this retracement, going up. Now we have this low and this low. And what happened is going below them, instead of finding reversal here, instead of continuing to the downside, what happened is continuation to the upside. Now same thing here, closure below, continuing to the upside, and then we go lower. This low here, because we are bullish, the last low does not matter here. It's about where the valid key level is. And you see here, same thing, same thing. And this keeps happening over and over. It's not the reversal is not as simple as this. It's not this pattern. It's the context. It's the alignment. It's the significance of the level itself. Now, the question is, and probably that's what you're waiting for, how to identify high probability breakout structure and market structure shift. Now, breakout structure is being with a trend, market structure shift is being against the trend. Two main rules before we go over the methods. We need to apply the price position, we need to apply the ranges and valid market structure. So whatever we learned in the previous lectures and episodes, we need to apply it here too. But we're going to be going over two methods. The first one is the two breakout structure method. Now the other one is the Edge School method. Now this one is only taught in my mentorship in Edge School. However, I'll give it for you for free for several reasons. One of them is that a lot of people, it's important to apply this in order to understand what level exactly to look for when we need to see a market shift as an example. So what levels do we consider a valid and significant one? So we're going to go over these. However, you still need to apply everything we've learned on the previous lectures. So as we said earlier, we have two methods in order to identify high probability breakout structures. The first one is the two breakout structure method. And this one, from the name itself, it's about finding, instead of one breakout structure, which is usually a trap, so something like this, where a lot of people look for this last low. And why is this a trap? Now, this is an additional thing, because a lot of times it's about this range from here, which got extended to here, because this one did no valid retracement. A lot of times there is a key level here, and it just, by the market dynamics itself, by the market nature, it wants to retrace to key levels in order to push to the other direction. So corrections, pullbacks. Now price will come here, and the key level itself is below this low. So this one is not a valid market shift, because price is only retracing to this key level in order to go higher after. So instead of doing this, instead of looking for the last low, what we want to see is the break below two lows. And it's better to even look for significant lows. That means when I say significant, it either respected a level before or it created a breakout structure. Now, it's not just a low that is internal, something like this, maybe something like this, where we break one low and another one here, not like this. What I want to see is a break again of two lows. So as price is going up, and this, all of these methods, they need to be aligned with a higher time frame key level. So as price is going up, let's say this is a 4-hour level here, and this one is 15-minute structure. As price is going up, and if you notice, we have this low that broke structure, and we have this low that also broke structure. Now, when price goes to these levels, so we have something like this, what I want to see is I want to see a breakout structure below this, because if we only broke below this low here, and then we started going up after, that is only what? A retracement, a pullback in order to continue higher. However, if we also broke below this low aggressively, that kind of confirms. Now, other times it's gonna fail too. So if sometime price is gonna go below this, if there is another key level below. However, just by adding one more breakout structure, it increases your probability of only looking for and identifying high probability breakout structure. So now what could happen is price going up and then retracing and then continuing lower. And you can always apply this. So you notice we have a low here, another low, breaking below both. Now we look for retracement in order to continue lower. Now, if we go to euro dollar here, you notice whenever we have this high and then this low, broke structure, what happened is even though we went below this level, which is this last low, that also has some other key levels below. So if you notice, price only went back to a key level, which is this one here, and then continue going higher. So this break here meant nothing. Now, when we go and look for valid highs and lows, and we want to find a structure that is actually, that has a valid structure or a valid low. So if you notice here, this low here broke this high. So it's a low that took a high or broke a high. This one as well broke above this high. So we have two breakout structure. That means we have two lows. Now this one is internal because it did not break anything. When we went below this, I also want to confirm by breaking below this. And when I have a break below this level here and it displaces below, this confirms that we might have a valid breakout structure because we broke below two significant lows. And then what happened after? We take our fib and we look for the range that we created. We look for OTE in order to look for entry. You might find an entry here depending on what key level you're looking at. Now, if you're looking for edge model here on the strategy that I teach on Edge School, we have it here. You find an entry here, just right here. Stop loss goes above the key level, and then you can target the external range, or you can also look for some other key levels below. Now, this one, very easy method. However, it actually takes your win rate from way lower to much higher just by adding one more breakout structure. Now, one tab of market structure trap is that whenever we have prices, after this huge breakout structure to the upside, we created a low, another low, and another low. And all of these actually broke structure. So this one, a breakout structure, and this one, another breakout structure. However, the size of the breakout structure compared to this main one, it still remains insignificant. And if you notice, where is the nearest key level inside of this range? The whole range here is unfilled. Where is the nearest key level? It's this one here. And that's where price actually fakes out below and then started going higher. So in this case, you want to still follow this external range because this one does not matter. We only went below the last low before the key level. So here, even now, this is regardless of the key level here, but when you add that too, you have a much higher probability. Now here, when we have all of these internal lows, and then we have the one that has the nearest key level, you also want to avoid this. Even if we break below two lows, if this one has a key level below, it's still invalid. Now, one example that we can see here, so this is the current market structure on euro dollar. And in this period, I remember an example, a good one happening here. And when looking back, I remember we've taken some trades here on Edge School with my members. Now, what happened here, if we go and analyze what happened exactly, is that here we had a high, we broke above, we retraced lower, and then we started going up. Now, what you notice here is that this is the last high before the break. And I'm going to show you my high probability, how it looks is something like this, where we broke above a high, we respect the key level here, and then we broke below that low that respected this. When I have this, this is the valid breakout structure. Now, if it has multiple touches, it's even better. So where do we look for the market structure shift? Below this low. Now, I'm going to give you 5 seconds, or you can pause the video here and try to find this in here. Where can you see it? Now, we can see it here. If you notice, we broke above this high. All right, we break structure. We did not respect this high. And then we broke another time where we have now this high. And what happened is a respect of that high. If you notice, this is a high broken above a key level, respected here, and we started going up. So now we have a respect of that level. So as we're going up, and then we started going lower, we respect that level. That means now this low is actually a valid level that we can look for short from. And then we broke below it. Now, I was a bit confused about this low here because the break, price immediately started going up, but it's still a valid closure below. I would really prefer another candle to close below, but it's still a valid example. Now, we broke below this, if you notice. The same level that we marked here, where it was respected here, now broken below. That is what a high probability breakout structure is. And if you notice, after the break below, what happened is a retracement up. And even if you were not sure about this closure, another closure here that is very strong, and then it went lower. What happened after is retracement to the same level that we talked about, another retracement to the same level. Now, an edge model that can be taken here is this one, and then stop loss goes above, and you see snapper entry exactly. So you had almost no drawdown, actually no drawdown at all. It just gets you in, and then start going lower. So if you notice, this is a good example of a valid breakout structure. Now, another one, so we have this level. Now, I'd really prefer for price to come here to the low. So if this week was a bit here, and then if you notice, we respect that level, we started going up, and then we were staying here, and then we close below. So another respect, and then we close below. This is also another valid one. And if you notice, what is this? After this huge move to the downside, retracement. So this one was a huge one, and there was no retracement here. However, if you notice, this level has been respected multiple times. Now, what is another example? I'm gonna go and find one with you. All right. So another example that I just saw here, you see failing to displace above this and then going lower. Now this might not be the clearest one. However, it still initiate a reversal. Now, if you notice here, as price is going up, we have this high that price retrace back to and respect. So that is one level that can be actually also a valid level to look for market structure shift. All right. But then after that, there's also another level where we started going up and we broke above this high. And then we also have another respect here. So another level is also here. And if you notice, a high respected by a low and then broken below the low. And if you notice, where does price retrace back to? The same area going lower, and also same level here. Now, I would really prefer to always enter when we have the market structure shift happening. That means if I have something like this and then we broke below, before price continue going lower, I'd really prefer to be involved immediately. Before price going lower, now this becomes a bit lower probability because the move could be already done. All right. So yeah, this is the edge call method. It's something that, I always apply, which is an example here. As price is going up, we have a high, this high. If you take it to the wick, respect here, and then broke below. What do we do now? This now becomes a valid. It's not just the last low, it's a low that is significant, and that's what happened after. Price coming back here and then pushing lower, and that is a valid breakout structure instead of just looking for, random things, which is not gonna work. So that's the end of the video. We learned the two methods, the edge call method and the two breakout structure method, in order to identify high probability breakout structure. If you have any question, make sure to leave it in the comment, because we will be having a specific episode where we answer the questions of the series. Make sure to share the video with your friends, leave a like as well, and make sure to check out It's Cool if you want to learn about my trading strategy and be on my community and trade with me. That's it, and I'll see you in the next video.